Good day, ladies and gentlemen. Welcome to my YouTube channel. Today, we're going to be looking at Introduction to the Audit Process. If you are a second-year auditing student, this is definitely for you. And if you are in your third year or doing your CTA and you just want to refresh your memory, then this is for you as well. So let's take a look at the learning outcomes. So at the end of this session, you need to be able to identify the primary types of auditors and the functions that they perform. Explain the benefits of an audit. Distinguish between assurance engagements and non-assurance engagements. Understand and be able to explain what is meant by fair presentation and reasonable assurance. Understand and be able to explain what is meant by limited assurance. And lastly, you need to be able to explain the inherent limitations of an audit. So what exactly is an auditor? Simply stated, auditors of all types provide assurance pertaining to information prepared or presented by one party to another party with the intention of inspiring confidence in the fairness of the information which is being prepared. So auditors provide assurance pertaining to information prepared by one person and presented to another person. So auditors come in and provide assurance that the information which has been presented by the one party to another party truly reflects the financial position of the company. So let's take a look at the different types of auditors. There's registered auditors who are external auditors. These are auditors who express an independent opinion on whether the annual financial statements of a company fairly present the financial position and results of the company's operations. The external auditor is not an employee of the company. The external auditor must be registered with the independent regulatory board for auditors, which is called the IRBA, and they also need to be registered with SICA. Internal auditors are auditors who perform independent assignments on behalf of the board of directors of the company. The internal auditor is an employee of the company, but must be independent of the department, division, or subsidiary in which the assignment is being carried out. So they work internally and they perform assignments on behalf of the board of directors. Then there's government auditors. Government auditors perform a role similar to that of the internal auditor, but within the government departments. They will evaluate and investigate the financial affairs of government departments, reporting their findings to senior government. Then we've got forensic auditors. Forensic auditors are auditors who concentrate on investigating and gathering evidence where there has been an alleged financial mismanagement, theft, or fraud. Forensic audits may be carried out in any government or any business entity, but it should be obvious to you that the forensic auditor needs to be independent of the entity and of the entity under investigation. Then lastly, we have special purpose auditors. These are auditors who specialize in a particular field, such as environmental auditors who audit compliance with environmental regulations, and VAT auditors who work for the South African Revenue Services and who are responsible for auditing VAT returns. So they are special purpose auditors. What is the characteristic common to these various audits, to these various auditors? The answer is simple, and the answer is independence. The registered auditor is independent of the entity that they are auditing. The internal auditor is working within the company, but must be independent within the company, right? Yeah, so one common thing that all of these types of auditors have is the characteristic of independence. So why is there a need for auditors? There's three reasons. Number one, the split between ownership and management. Entities are owned by people who do not manage the business. The owners provide the finance and appoint managers to run the business and require that the managers report to them at regular intervals on their stewardship or management of the shareholders' resources. So you have owners or shareholders who simply provide the capital and appoint managers to run the businesses. So auditors need to come in and provide assurance that the information which is presented by the managers to the shareholders represents the financial position of the company. Number two, confidence in financial information. In order to maintain the confidence of those who invest in business, whether they are members of the general public or investment companies, assurance is required that the financial information produced by the business organizations is reliable and credible. It is the auditor of the financial information who provides this credibility or assurance. So there's so many stakeholders involved. So therefore, we need confidence in the financial information, that the businesses are providing. Lastly, accountability. Directors must be held accountable for the way in which they run the businesses. Government must be held accountable for the way it spends taxpayers' money. Companies whose activities affect the environment must be held accountable for the way in which they adhere to their environmental regulations and legislations. So that's why we need auditors. The split between ownership and management, confidence in financial information, and a general accountability, right? So let's take a look at the types of engagements. There's assurance engagements as well as non-assurance engagements. So under assurance engagements, there's two types of engagements. We've got reasonable assurance engagements as well as limited assurance engagements. So when you're dealing with a non-assurance engagement, no assurance is expressed, right? So an assurance engagement is an engagement in which the auditor expresses a conclusion designed to enhance the degree of confidence of the intended users about the outcome of the evaluation. There are two types of assurance engagements that a practitioner is allowed to perform. For example, reasonable assurance, as I've already mentioned, and a limited assurance engagement. With non-assurance engagements, no opinion is expressed and therefore no assurance is provided. For example, if you're going to render taxation services, you're not going to express an opinion on anything. You're simply going to prepare that VAT return, right? If you are preparing financial statements, you're not going to express some formal conclusion. You're just going to prepare your annual financial statements and that's it. So that would be a non-assurance engagement. Let's take a look at the assurance levels. Auditors can provide two levels of assurance to stakeholders: reasonable assurance for audit engagements and limited assurance for review engagements. ISA 200 defines reasonable assurance as high, but not absolute level of assurance. Reasonable assurance can only be given when the practitioner has gathered sufficient appropriate evidence to satisfy himself that the risk that he expresses an inappropriate opinion on the subject matter is acceptably low. So when we say an auditor has has given reasonable assurance, the practitioner would have gathered sufficient appropriate evidence to satisfy himself that the risk that he expresses an inappropriate opinion on the subject matter is acceptably low. So that's reasonable assurance. Limited assurance is a level of assurance which is lower than reasonable assurance, but which is still meaningful to users. Limited assurance is required for a review engagement and not an audit, right? It's required for a review engagement and not an audit. So the nature of the review will be far less comprehensive than an audit, but the reviewer must still be satisfied that he has gathered sufficient appropriate evidence to support his conclusion. So we spoke about limited assurance. I spoke about limited assurance. I spoke about reasonable assurance. What about absolute assurance? Why can't an auditor give absolute assurance? Absolute assurance is certifying or confirming that the financial statements are 100% correct. The auditor cannot provide absolute assurance that the financial statements are free from material misstatement due to fraud and error. An audit can only provide reasonable assurance. Therefore, that is an unavoidable risk that some material misstatement may not be detected when performing an audit, and this is due to the inherent limitations of an audit. So the reason the auditor cannot provide 100% assurance or absolute assurance that the financial statements are 100% correct is because of what we call inherent limitations of an audit. ISA 200 provides the basis for the following explanation of the inherent limitations of an audit. So I've just summarized them here. So number one, the nature of the audit procedures, right? There are practical and legal limitations on the auditor's ability to obtain audit evidence, possibility that management may not provide complete information, and the auditor can't be certain that all the relevant information has been received. Audit procedures are not specifically designed to detect fraud, so fraudulent transactions can go undetected. Yes. So due to the nature of audit procedures, the auditor can't confirm 100% that the financial statements are free from material misstatement due to fraud or error. The auditor can only provide reasonable assurance because of the nature of the audit procedures. Number two, evidence is persuasive and not conclusive. An auditor is persuaded that an event took place by the presence of documents rather than actually witnessing the event. These documents could be false, but it is impossible to witness every single transaction that will take place in a company. So therefore, the auditor is persuaded by the managers that certain transactions have taken place, but the auditor cannot physically witness every single transaction that takes place. So therefore, the auditor can't give absolute assurance that the financial statements are 100% free from material misstatement due to fraud and error. Inherent limitations, accounting and internal control systems, right? The auditor is obligated to place reliance on the systems that the client has put in place to provide financial information. So if these systems that the client has put in place fail to detect errors and fraud, if these systems that the client has put in place are not effective, then there's no way that the financial statements which have been produced from these accounting systems and internal control systems which are poor, there's no way the financial statements can be 100% accurate, right? So therefore, the auditor can't give absolute assurance. timelines of reporting and balance between the cost and the benefit. The audit opinion needs to be reported within a reasonable time after the financial year end, right? And the benefits from the audit must exceed the cost. Therefore, this could lead to the audit being compromised in some way or another, right? So because of the timelines of the audit and the cost, and because of the fact that the benefit must exceed the cost of actually performing the audit, this could compromise the audit, and therefore the auditor can't give 100% assurance, right? The auditor can't give absolute assurance. And then lastly, other reasons, such as information being withheld. There are often aspects of the audit which are difficult for an auditor to gather sufficient appropriate evidence, which could lead to limitations, right? So if information is being withheld by the client, you can't give 100% assurance. You can't give absolute assurance that the financial statements are, 100% free from material misstatement due to fraud and error. So I just wanted to explain to you guys why the auditor can only give reasonable assurance and not absolute assurance. So let's take a look at public interest, right? An external audit of a company's financial statements must be conducted by a registered auditor. So how do we know which entities must be audited and which companies qualify for an independent review, right? Instead of an audit. So society and businesses are totally interlinked and rely on each other for their survival. If there's no business, there's no workable society. If there's no workable society, there is no business, no jobs, no products, no jobs. Therefore, if it is in the public interest, that there must be an audit, then there will be an audit, right? Therefore, it is in the public interest that there be a method of achieving the production and use of credible information in society. This method is known as auditing, which provides the assurance as to the truth and fairness of financial information produced primarily by business entities. So yes, like already mentioned, society and businesses are totally interlinked. So therefore, we will calculate the public interest score to determine if the company needs to be audited, because there's so many stakeholders that rely on the information that this business will be providing. The Companies Act introduced a new method of determining which entities required an audit of their financial statements. The decision is based rather on the level of public interest, like already mentioned, right? The decision as to which entity must be audited will depend on the level of public interest. So as a result, the Companies Act and its accompanying regulations stipulate that all companies and closed corporations calculate their public interest score for each financial year. The score is based on factors which generally determine the level of interest the public has in the entity. An entity's public interest score will be the sum of a number of points equal to the average number of employees during the year. So you have to calculate the total number of employees during the year and then find the average, and then that will give you a number of points equal to the average number of employees during the financial year. Then there's 1 point for every 1 million of turnover, right? Or a portion thereof of turnover. One point for every 1 million or portion thereof of every third-party liability at the end of the year. And then lastly, 1 point for every individual who directly or indirectly has a beneficial interest in any of the company's shares or members' interests. So this is your shareholders, right? Those are the people that have a beneficial interest in the company. So if there's If there's 10 shareholders in the company who directly or indirectly have a beneficial interest in the company's shares, then that's 10 points there. So that's how you calculate